Today, let us start with the comparative financial statement analysis, the MCQ part. So, in section A, financial statement analysis, in the question bank, we have 280 MCQs. So, in comparative financial statement analysis, we have 16 MCQs. So, let us start the 16 MCQs. In financial statement analysis, expressing all financial statement items as a percentage of the base figure is called. We know that horizontal analysis is also known as trend analysis or common base year analysis. So here they are asking common base year analysis. So common base year analysis is also known as horizontal common size analysis. Yeah, it's horizontal common size analysis. It's not ratio analysis, it's not market growth analysis, it's not vertical analysis. Next, preparation of common size financial statement is also referred to as. So what is common size financial statement? We know that the common size financial statement is also known as vertical analysis. So the other name for common size financial statement is vertical analysis, and which is the correct option. It's not activity analysis, it's not horizontal analysis, it's not liquidity analysis. Next, question number 3 is typically a difficult and challenging question, so we will do it later on. Let us flag this question and we'll come back to it. Question number 3 is question number 4 is also one of difficult and typical questions, so we'll do it later on. Proceed to the now here we have the following financial information is given. We have book value of assets, we have 18,000, 26,000. Market value of equity is given. We have 12 months ended year 1 and 12 months ended year 2 is given, and the income statement line item is given. So using a common size income statement, this means we are going to use vertical analysis here. So here we need to find the operating income and net income. The operating income or net income is increased or it has decreased. So the operating income, let us mark the operating income and the net income. So operating income, we know that it's income statement, so we are going to take the income statement line item and we are going to divide by the net sales and multiplied by 100. So what is the operating income? We have 500, that will be divided by 1000. 500 by 1000 will give you 50%. So operating income is 50% in year 1, and 600 will be divided by 1300 and multiplied by 100 because the sales is 1300 and here the sales was 1000. So when we divide 600 by 1300, you are going to get a percentage of 46%. So this means, the operating income from 50%, it has decreased to 46%. So first the operating income has decreased. Now let us do it for the net income. So net income will do also in the same way, that you are going to divide 120 divided by 1000. So when we divide 120 by 1000, you are going to get 12%, and when you divide 180 by 1300, that you are going to get 13.5%. This means your net income has increased from 12% to 13.5%. This means your net income has increased, and your operating income has decreased. So what happens to the operating income? Operating income has decreased and your net income has increased. Yeah, this is the correct option. Next, in assessing the financial prospects for a firm, financial analysts use various techniques. An example of vertical common size analysis is, so what is vertical common size analysis? Vertical common size analysis is, it's not an assessment of relative stability of a firm's level of vertical integration. It's not a comparison in financial ratio form between two or more firms in the same industry. Advertising expense is 2% greater compared to the previous year. This is an example of horizontal analysis. And advertising expense for the current year is 2% of sales. This is an example of vertical analysis. And the MCQ is asking about an example of common size analysis or vertical analysis. So vertical analysis, advertising expenses, advertising expense for the current year is 2% of the sales. So income statement line item divided by the net sales. So every item will be divided by the net sales. So that's why it's 2% of the sales. That is vertical analysis. Next, this is also one of the difficult and challenging questions. We'll come back to it later on. So here what do we have? Selected information for the company's year-end balance sheet is shown below. So the balance sheet is given cash, accounts receivable, total assets, and these all total equity and total liabilities and equity. So based on the above information, common size balance sheet for the company will show. So let us now analyze these all line item. So using the common size balance sheet, common size means we are going to use vertical analysis here. So in vertical analysis and its balance sheet, before we have done an MCQ related to the income statement. Now we are going to the balance sheet. In balance sheet, what we are going to do, we are going to take the balance sheet line item and we are going to divide by the total assets. So total assets will be the base. So where is total assets? So total asset, we have the value for total asset is 495,000. So every line item will be divided by 495,000. That will be multiplied by 100. So first line item, they are asking for the long-term debt. So the long-term debt is 100,000. 100,000 will be divided by 495,000. And when you divide 100,000 by 495,000, that you are going to get 20.2%. So long-term debt, they are saying at it's 74%. This is incorrect option because it should be at, it is at 20.2%. And property, plant and equipment is 69%. So where is property, plant and equipment? It's here. So 250,000 divided by 495,000. So when we divide 250,000 by 495,000, it is going to give you 50.5%. So it's not 69%, it is 50.5%. Now we are left with retained earnings. Retained earnings is 17%. So where is your retained earnings? Retained earnings. So retained earnings 60,000. 60,000 will be divided by 495,000. When you divide 60,000 by 495,000, that you are going to get a percentage of 12%. So this is not 17%, it is 12%. Now we have accounts receivable. So accounts receivable is 120,000. 120,000 will be divided by 495,000. So when you divide 120,000 by 495,000, you are going to get a percentage of 24%. And that is what account receivable is at, 24%. This is the correct option. So what we have taken balance sheet is given. So for the balance sheet, we take the balance sheet line item, we divide by the total assets, and total assets is 495,000. That's why every line item has been divided by 495,000 and multiplied by 100 to get the percentage. Accounts receivable. Next, The dollar value of company's ending inventory on its balance sheet was 500,000, 600,000 and 400,000 for year 1, year 2 and year 3 respectively. In preparing horizontal analysis, so here what we have to prepare horizontal analysis. So now let us see what they are asking. Respectively, in preparing a horizontal analysis in year 1 as the base. So first of all, year 1 should be taken as the base year, the percentage change, and we need to find the percentage change for year 3. So let us now calculate the percentage change. Percentage change is equal to current period is year 3, and the base period, they are saying that year 1 is the base period. So year 1 will be taken as the base period, and it will be divided by the base period and multiplied by 100. This way we can find out the percentage change. So year 3, what was the amount? Year 3, so let us mark the amount. So year 1 it was 500,000, year 2 we have 600,000, and year 3 we have 400,000. So year 1 year 3 the amount is 400,000. Year 1 we have 500,000. By year 1 we have 500,000, and that is going to be multiplied by 100, which gives you a percentage of what we can say negative, that is 20%, and answer B is the correct option. Next, a financial analyst is reviewing a company's most recent fiscal year financial statements. The relevant data is shown below. We have assets, liabilities and equity. We have cash, we have accounts receivable, we have inventory, we have plant and equipment, we have total. So liabilities and equity is given, total 2000. Okay. What they need. The analyst would like to examine the companies in relation to other firms in the industry utilizing common size financial statements. This means if they need common size financial statements, so we are going to analyze this using vertical analysis. So the appropriate comparative value of current assets. So they need the appropriate value of current assets. So let us mark what is your current assets. Cash is your current assets. Account receivable is your current assets. Inventory is your current assets. Property, plant and equipment is not your current assets. It's your fixed assets. So they are asking the value of current assets. So what is the value of current assets? It's 150 plus 250 plus 400. So what it is, it is total, it comes to 800. Now the current assets is 800. Now this is balance sheet. So what for the balance sheet, what we are going to do, we are going to take the balance sheet line item and we are going to divide by the total assets. So what is the balance sheet line item? They are asking for the current assets. So total current asset is 800. So we have 800. So let us do it here. So balance sheet line item we have 800, and total assets, what do we have? Total assets we have 2000, and that 800 divided by 2000 multiplied by 100, we are going to get a percentage of 40%. 800 by 2000 into 100, that is 40%. Next, a company has the following balances on its financial statements. We have revenues, we have cost of sales, we have net income, total assets and total equity. Common size income statement. Common size income statement, this means we are going to use vertical analysis here. And they're asking for net income. What is net income? Net income is 4 million. Income statement line item, we have 4 million. And net sales is 32 million. So it's 4 million by 32 million multiplied by 100. So we are going to get a percentage of 12.5%. That is 12.5%, which is 12.5 percentage. Next, this is also difficult and challenging MCQ, so we will come back to it later on. So let us do other MCQ. This is also challenging, we'll come back to it later on. So now here what they are asking, they're asking about okay, let us read the MCQ first. Shown below are the components of the company's financial statements. We have sales revenue, we have cost of goods sold, total assets, total equity, net income. The percentage value would net income be on common size financial statements. So they are asking about the net income and common size financial statements. We are going to use vertical analysis here. And this is income statement, the net income statement line item, net income, that is 120,000. By the net sales, we have 600,000 multiplied by 100, which comes to 20%. Next, this is also challenging question, so we'll come back to it later on. So this is the last and easy MCQ, and what we have marked, we'll do it after this MCQ. So here here they are using the horizontal analysis and the percentage change. A company's financial statements for the past 2 years is given. We have previous year and we have current year. Sales revenue, net income, total assets, inventory. Using horizontal analysis, what account has the largest percentage change? So here we need to find the largest percentage change. So let us first of all find out the change between the current year and the previous year, because you can use change by the original or the prior period and multiply by 100. So let us find out the change first. So what is the change? Now in the sales revenue, we have 6 million and 6.6 million. So the change is 600,000. And here we have 500,000 and 540,000. So the change is 40,000. And here we have 10 million and 10.5 million. So the change is 500,000. And here we have 600,000 and 500,000. So the change is in negative, that is 100,000. Now change by original into 100. So 600,000 by 6 million into 100. So we are going to get a percentage. So here we will get the percentage. Now 600,000 by 6 million. So 600,000 by 6 million multiplied by 100, that is 10%. 40,000 by 500,000 into 100, that is 8%. 500,000 by 10 million into 100, that is 5%. 100,000 by 600,000 into 100, that gives you a 16.6%. So this is 16.6%. So let me check the answer. Yeah, it is correct. It is 16.6%. Okay, the largest percentage change is 16.6%, which is inventory. Also, the inventory should be the correct option. So the sales revenue is 10%, net income is 8%, total asset is 5%, and your inventory has decreased approximately by 17%. Yes, it is 16.6, then it is 17%. Okay, inventory is the correct option. Now let us do the questions which we have marked. Now let me close the PDF, because for these why we have left question number 6. Advertising expenses 2% of sales. This is already done. So why we have left question number 6? So let me do it once again. In assessing the financial prospects for a firm, a financial analyst use various techniques. An example of vertical common size analysis is it's not an assessment of relative stability of firm's level of vertical integration. It's not a comparison of financial ratios formed between two or more firms in the same industry. Advertising expense is 2% greater compared to the previous. This is an example of horizontal analysis. And here we have advertising expense for the current year is 2% of sales. See, advertising expense. So advertising expense by net sales. So whatever the amount it will come to the 2% of the sales, because every line item is divided by the net sales. So that's why this item itself denotes that it's vertical analysis. In vertical analysis for the income, because every line item is divided by the net sales, that is 2% of the sales. Now the questions that we are left with 3, 4, 7, 12, 13 and 15. So let us do the flag questions, and now we will close the PDF, because for these questions we need a larger area for the calculation. So let us close the PDF. Now here let me read this MCQ. A financial analyst is reviewing a competitor's income statement for the past 2 years, year 1 and year 2. So this is income statement. So sales, cost of goods sold, gross profit, selling expenses, general expenses, operating income before income taxes, taxes related to operations, net income. The financial analyst is able to conclude that the competitors common size income statement, common size income statement, common base year income statement, common base year income statement. So here option number A and B is going to be analyzed using vertical analysis, and C and D we have to use horizontal analysis. So let us do this with the vertical analysis. So common size income statement will show operating income before income taxes, that is 22% for year 2. So we know that for the income statement every line item will be divided by the net sales. So operating income before income taxes 25,000, that is going to be divided by 275,000, and it will be multiplied by 100 to get the percentage. So what it will be multiplied by 100, so it is going to be multiplied by 100, so it is going to be 9%. So this is not 22%, it's 9%. Now common size income statement will show taxes related to operations. So taxes related to operations we have for year 2, we have 3,500. So 3,500 will be divided by 275,000, which is your sales, multiplied by 100. So 3,500 divided by 275,000, it is going to give you 1.27 percentage. So it's not 16%, it is 1.27%. So both the option is incorrect here. Now we have to analyze using horizontal analysis. A common base year income statement will show gross profit. So here we need to find the gross profit increase by 17%. So how we are going to find the growth? How we are going to find the gross profit? So using the horizontal analysis. In horizontal analysis, what we are going to do for the gross profit? The current year is 115,000 minus 95,000 the previous year by 95,000 into 100. So that will give you the growth rate or percentage change. So it is 21%. So this is not 17%, it is 21%. Now we are left with option D. Common base year income statement will show selling expenses increase by 14% in year 2 compared to year 1. So selling expenses increase by 14%. So say what is selling expense? So let us do for selling expenses. So selling expenses for the current year is 40,000 minus 35,000 by 35,000 into 100. So which is 14%. So this is 14%, which is the correct option. Option D is the correct option. Next is question number 13. So accounting manager of a manufacturer of farming equipment was asked by the CFO to analyze the company's last 5 years of operations. The accounting manager prepared the following analysis. Common base year. So common base year means this is done using horizontal analysis. Now sales is given. We have cost of goods sold, selling and administrative expense, research and development income from operations for year 2, year 3, year 4 and year 5 and year 6. So every year is compared with the year 1 as the base, because they have taken year 1 as the base. So the figures are given here. So let us see which one of the following statements is consistent with the analysis. With this analysis, which statement is correct? The company should decrease the sales force. See, selling and administrative expense has increased from 1.01 to 1.03. So the sales force has not decreased. It has basically it has not decreased, it has increased. So this is inconsistent with the analysis. The new marketing strategy has been unsuccessful. The new marketing strategy has been successful because the sales has increased from 1.01 to 1.10. So that's why this also is inconsistent with the analysis. The company should decrease research and development expense. See, the company from 1.1, 0.98, 0.99, 1. So the research and development expense, we can say it has remained constant. It has remained constant overall. So there is not much increase or decrease. So that's why this is also inconsistent with the analysis. Now the new production process has successfully reduced the manufacturing expense. So manufacturing expenses, what happens, the cost of goods sold from 1.05 decreased to 0.98. So from 1.05 it has went down to 0.8. So this is consistent with the analysis because the new production process has successfully reduced the manufacturing expense. Now we have question number 12. An abbreviated common size income statement for year 1's actual results and year 2 anticipated results are given below. For sales, so these are given in the form of percentage. So sales for year 1 we have 100%, for year 2 we have 100%, cost of goods sold 50%, selling and administrative expense 40%, and here it's question mark. Operating income we have 10%, here it's question mark. The corporation estimates that the unit sold. The corporation estimates that the unit sold will increase by 5% in year 2 with no price increase to its customers and no anticipated cost increase from its vendors. Assume selling and administrative expenses are 5% variable and 95% of fixed. If all predictions materialize, the corporation should expect selling and administrative expense in year 2. So they need what is the percentage of selling and administrative expenses in year 2. So we need to find what is the percentage. So if you have given like this MCQ where the percentage is given, so you have to assume certain numbers. So let us now do it. Now do it with the help of some numbers. So year 1 and year 2. For year 2, let us say that we have sold 500. Now, if you have made a sale of 500, so the corporate estimate the units sold will increase by 5% in year 2. So this will increase by 5%. So if it is increasing by 5%, what is going to happen? The amount for year 2 will be 525, because this has increased by 5%. Now the cost of goods sold is 50%. So 50% of 500, 50% of 500 is 250. The cost of goods sold will also increase by 5%, because the unit sold is increasing, right? The cost of goods sold will also increase by 5%. So if the cost of goods sold is increasing by 5%, so it is going to be 262.5. Now, selling and administrative expenses 40%. So 40% of 500 is 200. So selling and administrative expense this 200 cannot be increased by 5%. So selling and admin expense, there is a problem, because we have two components. So we have selling and administrative expense 5% is variable and fixed component. So the fixed component will remain fixed. So we have fixed component and we have variable component. So fixed component is 95%. So out of this 200, 95% is fixed. So for year 1, 200 into 95, we have 190. So the fixed expense for year 2 will be 190, and the variable expense is 5%. So variable expense is going to increase by 5%. So will increase by 5%, and it is 5%. So 200 into 5%, 200 into 5%, we have 200 into 5% is 10. So this 10 will increase by 5% in year 2, because that is variable. Fixed will remain fixed. So if 10% is increasing by 5%, so we get 0.5. No, 10, it is 10.5. Okay. So 190 plus 10.5 for year 2, 190 plus 10.5, which is 200.5. So here the selling expenses is selling and administrative expense for year 1 is 200. For year 2 it is 200.5. This is what the trick they have given us, the variable and fixed. Fixed will remain fixed and variable you have to change. So now we can easily calculate the percentage, that is 200 selling and administrative expense, that is 200.5 by 525 into 100. All right. So by this we are going to get a percentage of 38.19. Now the corporation expects selling and administrative expense in year 2 to be. So selling and administrative expense for year 2 less than 40% of sales. Yes, it is 38.19% of sales. So it is less than 40% of sales. Yes, it is 40% of sales. It's not 40% of sales. It is 38.19% of sales. Greater than 40%. No, it is less than 40%, but no more than 42%. This statement is correct. Greater than 42%, it's not greater than 42% of sales. That's why option A is the correct option. Now we have question number 7. A company has had the following financial results for the last 4 years. So we have sales, cost of goods sold, gross profit, inflation factor is given, year 1, year 2, year 3 and year 4. The company has analyzed these results using vertical common size analysis to determine trends. The performance of the company can be best characterized by which one of the following statement. So for this we need to convert your numbers into percentages. So this is vertical common size analysis. This is vertical common size analysis. So vertical common size, in vertical common size analysis, we are going to divide each line item by the sales. So we have to convert this into percentage, then we can see what is correct and what is not correct. So cost of goods sold is 750,000. So 750,000 by 750,000 by 1,250,000 into 100. So here we are going to get 60%. 785,000 by 1,300 into 100, that is 60.3%. 825,000 by 1359 thousand, here we are going to get 60.7%. and 850,000 by 1,400, so here we are going to get the same percentage, that is 60.7%. Now let us convert gross profit. 500 by 1,250, it's 40%. 515,000 by 1,300, it is 39.6%. 534,000 by 1359,000, that is 39.2%. 550,000 by 1,400, that is 39.2%. and the sales is at 100%. Now let us analyze the statement. The common size gross profit percentage has decreased. Gross profit percentage has decreased. Gross profit from 40%, 39.6, 39.2. Yes, it has decreased. As an increasing trend in cost of goods sold. So cost of goods sold 60%, 60.3%, 60.7%, and yes, the cost of goods sold has increased. So this is the correct option. Let us see the next one. The common size trend in sales is increased. Sales is at 100%, and resulting increasing in common size increasing trend in. So this is correct option because the common size gross profit. So this is gross profit margin. So gross profit margin has not increased. Sorry, and gross profit margin has decreased. Gross profit margin from 40%, it went down to 39.2%. The common size trend in cost of goods sold decreasing. Cost of goods sold, no, it's not decreasing, it's increasing. The common size trend in cost of goods sold is increasing because from 60% it went to 60.7%, 60.7%, which resulting in increasing trend in common size growth. Increasing trend in common size, no, decreasing trend in common size gross profit. So that's why this is incorrect option. The increased trend in common size gross profit percentage. The common size gross profit percentage has not increased, it has decreased. And resulting both increasing trend in sales is at 100%, decreasing trend in cost of goods sold. No, cost of goods sold has increased. So that's why option A is the correct option. Yeah. Question number 4. Okay. Now an enterprise is in the process of comparing its current financial performance for year 3 with the prior 2 years. The enterprise experienced exceptionally strong growth between year 1 and year 2, with a slight decrease in sales between year 2 and year 3. Which one of the following statement is correct using common size analysis? Common size analysis means we are going to use, first what we are going to use? We are going to use the vertical analysis. In vertical analysis, you know that every line item will be divided by the net sales. So let us convert these numbers into percentages. So we have year 1, we have year 2, and we have year 3. we have year 1, year 2 and year 3. Now we also need one of the line item that is missing is gross profit. So what is gross profit? Gross profit is the difference between net sales minus cost of goods sold. So 4560 by 2378 900, you are going to get the gross profit, which is 2181, and for year 2 the gross profit is 6325060, and the gross profit for year 3 is 5,138,235. So the sales for year 1 will be at 100%, 100% and 100%. So cost of goods sold will be divided by the net sales and multiplied by 100 to get a percentage. So we'll get a percentage of 52.16. For year 3 we have 79.58, and for year 2 it's 79.58, and for year 3 it is 80.6. So like that we'll do for the selling expenses. Everything will be divided by the net sales. So 490 by 4560, what we get a percentage of 10.7, and for year 2 we have 4.1, and for year 3 we have 7.9. Now selling expenses done. We have general and administrative expenses. So for general and administrative expenses we have 6.37, and for year 2 we have 1.6, and for year 3 we have 2.26. And for gross profit it will be the same way, that is, this will be divided by the net sales. So for the gross profit we have 47.84. For year 2 we have 20.41, and for year 3 we have 19.33. Now let us see which option is correct and which option is incorrect. The enterprise profitability has increased each year. The profitability has decreased. The profitability has not increased. The profitability has decreased each year due to more efficient production process. No, the production process was not efficient because the cost of goods sold has increased from 52 to 80. So it has decreased, and more efficient, no. So let us see the next option. The enterprise experienced the highest proportion of selling expenses in year 2. Selling expenses in year 2 lowest, not the highest, lowest, because it is 4.1. Now the enterprise increased the percentage of general and administrative expense each year in order to manage the company's growth. Then the enterprise increased the percentage of general and administrative expense. The percentage increased the percentage of general and administrative expense each year. So the company didn't increase the general and administrative expense each year, because from 6.37 it went down to 1.6%, then it increased to 2.6%. So each year it has not increased. That's why this is incorrect option, this is incorrect option, this is incorrect option. The enterprise proportion of gross profit was lowest in year 3. In year 1 we have 47.84. In year 2 we have 20.41%, and in year 3 we have 19.33%. This means the enterprise proportion of gross profit was lowest in year 3 due to high production cost. High production cost means this is cost of goods sold. This means 52.16. In year 2 it is 79.58, and year 3 it is 80.6%. So the correct option is option D. So we are left with question number 3. So this is also one of typical and difficult question here. So let us read it first. MCQ number 3. A company has provided the following data pertaining to one of its products. We have year 1 and year 2. Unit sales is given, unit sales price is given. We have gross profit margin is given. Which one of the following statement is correct? So before analyzing these four options, we have to find out the GP amount. We need to find out the gross profit dollar amount. We need to find out CGS, the dollar amount, and we need to find the CGS per unit. So we have GP in dollar, CGS in dollar, and CGS per unit. No, so for year 1, we have 45%. So gross profit margin, GP margin, which is 45%. So GP margin is equal to GP by sales. So what is your GP and what is your sales? Your sales for the year 1 is 1000 into 50. So 1000 into 50, that is 50,000. So your sales is 50,000 and your GP is sales 50,000 minus CGS. So your sales is 50,000 and your gross profit margin is 45%. So 45% into 50,000, that is 22,500. So that will be your gross profit amount. So 45% into 50,000, we get 22,500, and we have 50,000 minus CGS. So your CGS will be, so your CGS here is 27,500. So your GP is 22,500. Your CGS is 27,500. And 27,500 by 1000, you get 27.5 as CGS per unit. Now let us do it for year 2. So for year 2 is the same thing. We have 48% is equal to GP by sales. So your sales for year 2 is 1200 into 55, that is equal to 66,000. So if the sales is 60,000, GP is 66,000, sales minus cost of goods sold is your GP, and the sales is 66,000. So 48% of 66,000 is, now here we have, and this is 48%. Now by solving this equation, we get 31,680 is equal to 66,000 minus CGS. So the CGS is equal to 34,320. So the CGS is 34,320 and your gross profit is 31,680, and your CGS per unit is 34,320 by the unit sales, that is 1,200. So that is 28.6. So now let us see the options. So first is option A. What it is? The cost per unit sold has decreased by 3%. So cost per, let us find out the cost per unit. So we have 28.6 minus 27.5 by 27.5 into 100, which is 4%. So the cost per unit has increased by 4%. Now the dollar amount of gross profit. So what the dollar amount of gross profit has increased by 3%. So let us check for the option B. So the gross profit we have 31,680 minus 22,500 by 22,500, which is 40.8%. So this is not 3%, it has increased by 40.8%. Now let us do for C. The percentage increase sales price. Sales price, what is? Let us do for C. The sales price we have 50 and 55. So 55 minus 50 by 50 into 100, which is 10%. The percentage increase in sales price is 10% and exceed the percentage increase in cost. The percentage increase in cost of goods sold is 4%. So what is saying, the percentage increase in sales price exceed the percentage increase in the cost of per unit sold. So this is the correct option. The cost per unit increased during year to in line with the increase in unit sales. The increase in unit sales, the increase in unit sales is 10%, but it's not in line because it's 4% and 10%. So the correct option is option C. Yeah, so let us finish this. So we have done total 100 questions and we are standing at 100%. So let us come back to the dashboard and look at our statistics. MCQ, we have financial statement analysis 16. We have done 16 questions. We are standing at 100%. So you can check your statistics here. We'll return